All right, welcome back, everybody, to another episode of Making Sense. I think this is will be our third or fourth episode now. So today we have the general partner of VMG, Wayne Wu, with us. Wayne, how are you?
Hey, I'm doing great. Thanks for having me on, Drew.
I was stoked when I met Wayne for the first time not that long ago. So I was kind of weird outsider guy asking for 45 minutes of Wayne's time to come on the pod. So I was super stoked when he agreed to do this, because I think we're at a very interesting time, sort of in our industry and in our capital markets, and who better than Wayne Wu to come kind of break it down with us. So Wayne, would you mind just giving the audience a little bit of information sort of about yourself and about the firm? I mean, I think pretty much everybody listening to this will certainly be familiar, but I would love just to hear the spiel from
Sure.
you, sort of from the horse's mouth too.
Well, first, I want to send a shout out to you. I think you've created such incredible industry content. I
Thank
honestly
you.
open up my LinkedIn each day looking forward to seeing what type of analysis that you've shared with the community. And I think it's been amazingly helpful and just
Appreciate
really
that.
provoking. So I want to send a shout out to you. But as it relates to VMG, we've been one of the most longstanding firms within the consumer investment space. The final close of our first fund was summer 2007. I joined shortly after the closing of that first fund, so I've been at VMG for about 18 years.
Awesome.
When I joined, I certainly felt like one of the young people in the industry, and it's really struck me when people start telling me, "Hey, how was it back then?" Or "You're one of the OGs," or "Wow, you're such a great mentor." I think all of those things really imply age. So I feel very old now, Drew. But
Experience, not old, just experienced.
right, right. I think that's just given, both VMG, but then, and then just my time at VMG, just, we've just it's been a great journey of experience. Really, being in the early days of the health and wellness movement,
Yeah.
uh, with brands like Kind, Justin's, Quest, Pirates Booty, Pretzel Crisps, and learning through those journeys of partnering with great entrepreneurs and founders and seeing a lot of parallels of what we're seeing today, where health and wellness has become even more mass market, as in part
Yeah.
through a function of the GLP-1s and the Maha movement. So I think we're in a very interesting time.
Well, this is actually this. I was gonna. This is lower on my list of agenda and questions, but I'm glad that you brought it up. So okay, so is it fair to say then that like VMG was basically early to the sort of like better for you movement, and that started in the early 2010s maybe, and so you guys were well positioned to kind of ride that way from the beginning. Is that like where VMG made their name? I guess I don't necessarily even know.
Yeah, that's a great question, Drew. So when we started back in that, the technical start of BMG was 2005,
Okay.
and that's when a few of the founders had started the firm and really started the fundraising process. So we look at 2025 as really the 20th anniversary of the fund.
Congratulations.
VMG1, the final close of VMG1 was summer of 2007, and again, I joined shortly after that. And I'd like to tell you that there was some, huge thesis that we had at that time around health and wellness, but it was really just happening right before our eyes.
Mhm.
It was really the incrementality of change. And we've always believed in that dynamic. We haven't believed in the step function of change in consumers. And what I mean by that is, you know, consumers don't go from eating something tremendously unhealthy with a long ingredient stacks with ingredients that you can't see or pronounce and go straight to eating carrots. Uh, they have a consumer journey to them. They're going,
Yeah.
like Justin's, they're going from something a bit more unhealthy to a cleaner label Justin's nut butter. I think Daniel Lebetsky at Kind really articulated that well with, I think, something that's struck by me for over nearly 20 years now of how he grew a brand around ingredients that you can see and pronounce. And
Mhm.
then he articulated that through clear packaging. So almost like the transparency of those ingredients, where at the time, the category was trying to hide what the product looked like in terms of the nutritional bar
Yeah. Yeah.
category, where he highlighted the whole nuts and fruits that comprise the Kind bar. And as a result, we became really part of that first wave of the health and wellness movement. And when we look back at the history of the space over the last 20-ish years.
Yeah. So the reason that I think it's this is going to be such a good topic of conversation is because like and maybe you'll disagree with this, but like, so Iris, right? Like we have, 150 brands or whatever it is. Some of these wellness, like health and wellness oriented, like specifically like the protein and electrolytes companies are doing like numbers that like probably have never been done like ever before. At least like some of the things that I've seen just in terms of like growth and profitability. And so I'm wondering from where you sit, like is this like the beginning of like another new wave of something like that, or is this just kind of like flash in the pan fads? I assume that you know some of the companies that I'm sort of referring to, and there's a ton of them. There's a ton of them, and everybody knows it, right? I mean, even like there's like 10 different protein bar companies that are like somehow the fastest growing protein bar companies in the world. So I'm curious, just like because you've seen that cycle before, sort of specifically with regards to health and wellness, like where do you think we are today in this whole thing?
I think we're in a much larger transformational time than even when we first started. Um, what we found in like the first wave is it was a bit more coastal in nature. I think there was a transformation occurring and that's continued to occur over the last 20 years. What I think is really interesting about this time period is it's changing the way a much broader consumer and community they're thinking about ingredients and health in communities and demographics that have historically not been leaders in that regard. I think I credit a lot, again, like I mentioned earlier, in terms of like GLP-1s have been
Hmm.
a great influence in consumers thinking about their health. It jump starts their health and wellness journey in terms of weight loss, but also then thinking about how do I maintain this as I come
Yeah.
off GLP-1s. And then, the Maha movement in terms of just ingredient awareness. Think about the number of consumers that even thinking about dyes. But once you start thinking about dyes in your food, you start reading the ingredient stack. And naturally, a consumer is going to ask, "Hey, what are all these other things that I'm eating in my packaged food?" And anytime I think there's an intellectual curiosity related to what consumers are putting in and on their bodies, and then you
Hmm.
multiply that by the larger mass community that's asking themselves these questions, I think it lends itself to tremendous opportunity for entrepreneurial brands like you were speaking of to scale very quickly.
Yeah. Yeah, there's just like so much demand right there, and honestly, a lot of them are like digitally native too, and they can just supply that demand so much faster, and so they grow like crazy. I think another interesting sort of like angle of this whole thing, so like there's a lot of investors that popped up in like the 2010s, and they were all funding sort of this like better for you like food and beverage movement.
Yep.
And then eventually, like you could only make, so many investments in so many better for you, like oatmeal companies. And so they started to like, and this is when I was running Mad Rabbit, my last company, which was very much a
Yep.
clean beauty company. A lot of those food and beverage funds started to like kind of turn their eye towards beauty. And so I'm curious, like where you think, from like a food and beverage versus like beauty versus like health and wellness perspective, is there anything that VMG or Wayne, individually are more sort of excited about categorically at this point?
Yeah, I mean, I think right now you're seeing the same dynamics happen because I think part of what you're talking about ingredient awareness, not only what you put in your body, but just what you're putting on your body. And your
Right.
largest organ of your body is your skin.
Yeah. Yeah.
And it's these same questions that consumers are asking themselves. I think the other thing that's happening is the continued evolution of channels. Because I think you look at traditional mass and grocery channels, it's been more of the older brands that you see in beauty and personal care that are, that have the same dynamics that you see in other parts of the store where the ingredient stack is a bit dated, and you're seeing same dynamics of entrepreneurial brands disrupting the space with a much more natural yet efficacious formulation, and then they're pairing it with kind of young vibrancy behind how they're building these brands,
Mhm.
whether that's related to just package design, their influencer type relationships, things of that nature.
And do you think like does that ever stop, or is this like a forever paradigm of like things will always be getting cleaner and always be getting better for you? I mean, I've seen a few brands that have said like this whole thing is overdone. Like we're gonna put some sugar in our whatever protein,
Yep.
or does it just like forever go one way down the spectrum? Do you think?
I don't think it's black and white like what you're describing. I don't think it's, hey, every like it's I think it goes back to the discussion that we had earlier about the incrementality of change, that people don't go from, in your example, they don't go from eating sugar to not eating any sugar. It's not a binary dynamic. What I do believe in is we have so many avenues and mediums for continued education and self-improvement, whether that's, various online mediums,
Hmm.
podcasts. It leads to intellectual curiosity where the consumer is making changes that are better for themselves. So, for example, anything that's ingestible has to taste good.
Yeah.
And so we're only going to make forward progress on health and wellness to the extent that companies can still make that taste appetizing.
Hmm.
So I do believe in the continued incrementality of change for the better, but I don't believe it's going to change overnight. And I only believe that's going to be the case if it tastes good as it relates to ingestible products. And as it relates to topical products like skincare or beauty, it has to be efficacious.
That's actually that's a good insight. Sort of like taste as like a governing parameter for the ability to accelerate into cleaner and cleaner ingredients. That's kind of interesting. And I think that I want to switch gears just a little bit on a similar vein. I mentioned that I wanted to talk about a little bit about some of these like bigger companies kind of breaking up, and
Yeah.
then there's all these divestitures. You have, I think it was Coty that announced, we're recording this on September 30th. So Coty announced today that they're sort of doing a strategic review on their color cosmetics business, specifically Kellogg's obviously split in half, Keurig, Dr. Pepper split in half. The first question that I have is why do you think that is happening? And is it related to what we were just talking about in terms of like these big companies just move too slowly to sort of capture that new demand? Or is it a different reason? And then I have a follow-up question as well.
Yeah. I mean, we've had a long period of consolidation. I think it's basically been a period of consolidation since I've been in the industry. So you look at the last, I don't know, 10 to 20 years, you see the big get bigger, and there's
Hmm.
all sorts of like synergetic reasons they give for why they do what they do. And what we're seeing is at the end of the day, they're rewarded on growth. And they've gotten so big that it's really hard to continue to grow
Yeah.
especially when you overlay the dynamics that we're talking about as the theme of your show today, which is like where the consumer is headed. So as a result, I think you're seeing a number of these larger conglomerates splitting themselves up into different strategic units, and how they decide to break up of what's a strategic unit is different depending on the company. One company may say, hey, I'm taking the ones where I think are higher frequency, higher velocity categories. I'm going to put them in one bucket, like snacking per se. And then I'm going to put all my lower velocity items, or velocity categories or brands in another
Hmm.
and this enables, one to be able to unlock the growth versus the other that was dragging down growth. And the sum of the parts was
Right.
something very beneficial for the overall shareholders. And what impact that has, I think, for consumers and the company is they themselves can then innovate in a more focused way. So it may give them a chance at a higher hit rate on their own internal
Hmm.
innovation, but it also gives clarity on their M&A pipeline. What is a fit? How can it move the needle for them? By
Yeah.
creating smaller businesses, they don't need as quite of a big of a business in order to make an acquisition and have it move the needle for them. So as a result,
Okay.
a benefit to, I think, the whole ecosystem in that regard. Most importantly, the consumer. I think the consumer is going to get access to better products at more attractive price points in more widely available locations that I think will be a benefit to ultimately shareholders of these largely public entities. I think it'll give
Yeah.
more homes for entrepreneurial brands that are privately owned, which then will lead to more entrepreneurship by founders, which then will lead to better products again for consumers.
Okay, so that was my follow-up question is like, what is the impact of this sort of on like the M&A landscape? And I go back and forth on this. You would know better than I would. So like on the one hand, I totally agree with you that there's more buyers that can buy smaller things, right? And so theoretically, there should be more buying. I guess my question to you, and I don't know the answer to this, would be like, so it seems like every company is going through this like portfolio review. Like, are they able to like divest and acquire at the exact same time, or is it usually like they're focused on one thing and then they'll switch over to buying, or can it happen concurrently or no?
You generally find that it doesn't happen concurrently.
Okay,
Um, for obvious reasons that just like human bandwidth, you know,
literally bandwidth, yeah. So
literally
then
there's
in the near term, this would be more of an overhang than a tailwind. But you're saying medium term, long term, more of a tailwind for if I'm like somebody who's like running a brand that's 2 or 3 years old, and I'm kind of like I'm thinking about that, that next milestone out. Like, is this a good thing or a bad thing? Is like the crux of what I'm trying to get at.
I apologize. I'm gonna give you another say. I don't think it's binary like that. I in any in my opinion over my last 20 years, I find that the M&A environment is always varied, meaning there's some companies that are very much open for business for acquisition, and there are some who are not for a variety of reasons, whether it's, they're too highly levered, or
Hmm.
they're focused on internal growth initiatives. They're divesting a number of businesses. They're going through some type of leadership change at different levels of the organization. For whatever reason, they're on the off button on acquisition. And so I don't think today's any different. I think if folks are building a really great brand with great sort of financial performance that where they play in a large enough TAM, there's there's going to be somebody that's very excited about that if it lines up with the health and wellness trends of where people are going. There's a home for that brand. So there's no situation I can think of in the last 20 years where every strategic buyer is open for business.
Hmm.
There's always something going on. Some are on, some are off.
Okay, so then that probably informs what my next question was going to be, which is like, how, if at all, does all this activity impact you when you sit at VMG and you get a pitch deck across your desk, and like, are you like, does it change how you think about underwriting these brands like at all? Is the answer no?
No, I mean, I think the way we thought about brands have pretty much been the same over that entire time horizon. We've kind of stuck with our general philosophy around things, even during the height of the 2010s when, you had other investors that were just going after gross sales growth and low gross margins, burning a lot of cash. And those were never the right fit for us. We've always believed in a sports analogy. We've always believed in a balanced game plan. We're gonna run the football and throw it, and we're gonna make sure we play good defense. It's never an all offense sort of approach. And I think that leads to consistency in building, great brands, but certainly great businesses that are alongside these great brands that give it a higher probability for a strategic exit.
Yeah, I mean that makes sense. I guess in terms of then going a little bit downstream, maybe on like the brand side. So if you don't think that it changes how like brands should theoretically be like capitalizing themselves, or like, or sort of modeling their businesses, or running how that should be building, when when is a brand like ready for capital, and specifically like VMG type capital, which I would consider to be bigger checks, growthier stuff. And I think that's a fair generalization, but correct me if I'm wrong. Like more growth style stuff, as opposed to and we had a nice conversation actually a few weeks ago, sort of about like the venture capital boom. So I want to touch on that too. Actually, why don't we just go straight to that? What's your sort of overall feeling for like what we did see, which you were just saying, right? In terms of like there was a lot of folks that were out there that were underwriting in interesting ways. And so like where are we at in terms of like that cycle and like what's left of that, and like when is the and then down after that it's like when is the brand ready for capital and like why? I think that's a really important thing for founders to understand, because oftentimes people come to me and they're just like, I want to raise money, and I'm like, well, why? And they're like, I don't know, everybody does it. And I'm like, well, who do you want it from? And they're like, I don't know, like whoever will give it to me. And I'm like, those are the worst answers ever. So I'm curious, like what was your experience over the last, it was probably, I don't know, like 8 years maybe, in terms of like seeing a bunch of these sort of emerging fund managers pop up. And it's not the emerging is like the inherently bad nature, but like people who kind of were on the margins in terms of like generating alpha and kind of going after the wrong things. Like talk to me a little bit about your perspective on that whole evolution, and then how founders might, kind of learn from that.
Great. Well, to start, we're certainly not perfect. So I think in what I describe, it's not like we have all the answers.
Hmm.
My response was basically, I think we've had consistency in our belief and approach. Um, but as it relates to like the market today, I just think we have a much more rational market, and
Yeah.
I think and then I think there's a good alignment between entrepreneurs and investors on what the goalposts look like, which is really great. I think we went through a period of time, kind of like I would describe it maybe 2020 to 2023, where I think there was a disconnect between what entrepreneurs thought they should be shooting for versus what investors were evolving into, and it
Okay.
created this disconnect in conversation. Today, I think there's alignment around what what the overall investment community is looking for from a very early stage, related to TAM of what they're going after. What is their unique edge on why they're starting said brand? Is there gross margin to start? I think there's better gross margin businesses than I've seen since maybe probably the early days of VMG. That, like I said, there was a period of time where I thought like gross margin discipline was really lost. And today you're seeing much healthier businesses from the start that have closer to the right level of gross margins for whatever category that they may happen to be playing in. And as a result, I think you have the ones who continue to invest in earlier kind of seed type stages. These are the folks that really know that stage, and they know what are the signals they're looking for in order to make, to be able to fund the type of businesses you're talking about.
You said something that was interesting, which was gross margin discipline was lost. I think I know directionally where you're kind of getting. Every time I do like some breakdown on a company or like analyze a company, like it always starts there. And really in apparel brands, it's very, very difficult to recover from some significant gross margin contraction that just like kind of erases like your ability to reinvest in driving revenue. So when you say like gross margin discipline was lost, like what does that mean specifically in terms of like what you were seeing on the field? Like people just pricing low enough to try to pursue growth, or was there something more in the cost structure there? Or like what do you think was like truly the mistake that folks were making at that point in time?
It was a combination of both directions. I think that's what happens when you end up with no gross margin is they're underpricing a product, and they may be launching a product that just doesn't have the level of realistic efficiency for production that's possible.
Mhm.
And so the product market fit of what the realistic demand is for a given product and how hard it is to procure or make it just isn't aligned. And then you had a period of time where a business was launched this way, and there was an investment community at the time that was willing to fund it, and all aligned around how volume will solve that gross margin issue. And the 2010 prior to 2020 time period proved to a lot of businesses that volume doesn't always solve gross margin challenges.
Yeah, that's super interesting, and I feel like that's very also very common in just like people who are starting out and they're like only really pursuing like a retail model, and
Yeah.
it's like, well, as long as I just like get the volume, then like my cogs will go down, and I'm like, well, your cogs are like already, how much lower could they possibly go, and people seem to not understand the how fundamental like gross margin like truly is like to literally like the financial model of these businesses. And so I guess another sort of natural follow-up question then to that is like how do you think about like as an investor, how are you thinking about sort of channel distribution? I think I'm hearing a lot of like retail oriented things here. Is that like, and I think at one point retail was dead, and then like at one point D2C was dead. And I had a really nice conversation a few years back with Michelle from Moelis, who I'm sure and she had a pretty insightful take on sort of this, and I wanted to hear sort of like how you thought about like everyone's always like chasing some goalpost in terms of like, oh, I have to be in mass retail, or oh, I have to be on TikTok Shop. Like what's like sort of the guidance that you would give an entrepreneur who is considering like channel diversification and how they should think about expanding their business?
There's not any one way to do something. I think sometimes people get too far into the weeds of like what is the specific product and channel I should sell in, and that not step back and say, hey, in this given category, where do consumers want to buy said products?
Yeah.
It comes down simple to that. And then where you start doesn't necessarily mean where you finish. So for some categories and some businesses, it may be optimal or fine to start D2C. In some categories, it's more optimal or fine to start in retail. In some, it's somewhere in between of Amazon to maybe some of the retailer.coms. There's not one way to do it, but it really depends on the category, um, the shipping weight. There's so many different the price points where you can build
Mhm.
AOV. What is the type? What is it? More of an impulse purchase versus a replenishment item? There's so many factors in terms of like what is the right starting channel, and then
Yeah.
what is the channel of proof points that you need in order to be attractive for an acquisition. There's a lot of different questions and answers to be asked and answered over time on
I think
channel.
this has become an unplanned but nice format because I think we're covering a couple of really good boxes here. So like we talked about sort of like just natural consumer tailwinds and like how it's important to like have some sort of trend. The fundamentals of gross margin obviously are extremely important. And then sort of from a distribution perspective, like you're saying, it's less about what's the right thing to do and more about what's going to lead to the underlying fundamentals actually improving inside of the business. So I think like one thing that I really wanted to get your input on was like given all those things, right? Like when is a brand and a founder like when, and this might not have a binary
Yep.
answer like I keep asking, but when are we ready for capital? Like is there a point in time where those types of fundamentals sort of converge and you say, hey, like this is ready to have some gas on the fire? Or is there like a spectrum of answers where it's, hey, like this is a really good team and maybe they'll figure it out? I mean, I don't think you guys are quite that early stage, but like is there like a couple of different lines that can cross where you get really excited as an investor and you feel like there's a real opportunity?
Yeah, for us at least, how I'd like to define is we really love businesses where there's clear proof of concept. We A lot of times we get asked, "Hey, what's your minimum revenue threshold, minimum check, or
Mhm.
minimum EBITDA?" I like to describe it as we really want to see proof of concept. And how we describe that is it kind of depends on the category, depends on which channels they decided to start in, kind of similar to the point that we were talking about earlier. If it's D2C, we want to see a couple years of data, be able to look at what the retention rates look like.
Yeah.
And the reason for that is we want to see that they're not just churning customers.
Yeah. Yeah.
Eventually CACs continue to increase, and in theory, you run out of customers at some point. Um, But at the end of the day, we're trying to look and go, at the end of the day, are consumers coming back and buying more? Is there real repeat behind this brand? If there's retail distribution behind it,
Right.
we'd love to see sort of the sell-through performance on it. Do we understand what quartile those products are selling in whatever the category may be? Do we see top quartile performance? Do we see top half performance in terms of velocities? Because at the end of the day, they're trying to justify their real estate within that given retailer. So we want to see, you see a theme here, whether it's D2C or Amazon or retail. We're trying to just simply see, we're trying to find, is there real consumer demand signals at the end of
Mhm.
the day that we can use data to get our arms around? And then do we have good unit economics? You know, we have all the obvious ones on
Yeah.
D2C, but also do the gross margins work for whatever category that happens to be? And do they play in a large enough TAM where we can build a scale business, and hopefully a future strategic buyer sees that they have a lot of white space for them as well? And then most importantly, do we have great alignment with a potential founder partner that's looking for the type of help that we can bring from a VMG perspective, and that we're all aligned on what the end goal looks like of what we're all trying to build together as partners?
And what are those things that you think an investor can be particularly helpful with? Because this kind of goes into you. So you just answered the question of, when are we ready for capital, which is, I think, this is a gold mine. I don't know what Wayne's hourly rate is, but you guys should all be paying it. So like that's great. Like I'm glad that we can understand like when are we ready for capital, but then it comes to the question of like who is the capital from, right? And I think oftentimes people don't really think about that, and they just go with the best terms or the highest valuation or like whatever the case may be. So like how does like VMG think about positioning itself and differentiating, and what kind of value like you guys feel are confident that you can bring to a founder, and like why should they go like with that instead of higher terms? Like I have my own answer to that question, not VMG specifically, but like it's
Yeah.
more about the partner and the alignment and the value add than it is the sticker price of valuation.
I've been thinking about this question a lot myself lately. And I think we're in a time period where I feel like entrepreneurs are not asking the right questions to their potential investment partner. I think they're basing their decision at some points almost like too much off relationship or terms, or some combination of relationship and terms, and not doing the right level of due diligence on whether that individual can help them. And
Mhm.
it really comes down to individuals who can be helpful as an investment partner. So whether that's like being able to truly have retailer relationships, so many investors claim they do, but they really don't. Um, can they, do they have, are they able to help build great teams? Do they have folks do they have a talent team that can help them bring in really great team members? Because great brands are built by great people. They may say they can help, give the right level of guidance towards building towards a strategic exit, but they may have had one or none in there. So like they don't really exactly know how to get there, maybe either, but they're the ones supposedly providing that guidance. And I think lastly, I feel like entrepreneurs under reference investors, and they don't go through. So I think that's probably where they need to spend a lot of time before they marry an investment partner, is to really speak to. I throw this term out. I throw this stat out. I think they should talk to 10 people that they've worked with,
Oh
and
wow.
most of that list not provided by the investor, to really get a feel for them. And if they can't find 10 people, they should ask themselves, hey, is this the right partner for me? Because they may not have maybe been around doing this long enough. And then secondly, don't just reference a firm, because at the end of the day, they don't get a firm, they get a
Yeah.
person too. And they may work at a firm that's been around for a long time, but do they actually have the right experience to help that entrepreneur, and in making sure that they do the right diligence around that as well?
Yeah, and just given like all the experience that VMG has sort of with, successful exits, there has to be like some sort of like proprietary learnings that you guys like have, and like, like, do you have like relationships like with those strategic buyers that you can kind of like have a sense for like what's the read on the field right now and like what are they looking for and like because there is that, right? And like to your point, some people will act like they know what the answer to that question is, but they may just be sort of lying.
And again, I just want to highlight again, it's not that we have all the answers. I just think we have the benefit of having done this for, 15 to 20 years and been through brands that have gotten there a number of times and then brands that haven't gotten there. And I think you learn a lot from both scenarios. As it relates to like how to get there, it's a balance of the right historical context and the right current information. And it's certainly one aspect. So, like, if you don't have the historical context, but you only have the current relationships, I think you miss the historical context on what people say
Yeah.
they're going to do versus what they actually do. And by having the historical context, you can reference over time the discrepancy between what people actually do.
Hmm.
But it's important to also have current context because things change over time. So you have a balance around, hey, what are people interested today and having those right strategic relationships? And then you balance that with historical context with enough sample size or N in order to provide a very holistic piece of advice for entrepreneur partners.
I think the historical context piece is a really good point. Because so I have been sort of like in industry now for like 10 years or so. I've over the last like year or two, I've sort of gotten to the point where I feel like I've just now started to see enough things where it's like, oh, I remember when this was supposed to be that, or that was supposed to be this, or like, whatever it was. And I just remember like when we were running Mad Rabbit, it was, we were 24, 23 or whatever. And I just look back at like that point in my life and I'm like, I can't even believe we were ever, doing, doing anything. I should have been at home with my mom. So yeah, the historical context I think is a really good point. And, you know, again, I don't want this to turn into like a lecture for founders, but I do think that acknowledging that, especially if you're a young founder, acknowledging that and that like an investment partner can bring that to the table, like a board is like a good thing,
Yeah.
or it should be a good thing at least. And if you can create, like if you can take on capital and you can sort of create a board and you have, maybe even like an independent an investor and like all these people, like these are supposed to be like very, very experienced and wise and successful people that are trying to help you, you know, help the brand succeed. So I think you kind of goes back to your point about alignment earlier as well, which honestly also another thing that I think a lot of investors don't address head on. So basically, it's like we find some exciting company and we want to give them, our money and we are going to push them to like, and maybe this is another good question, but like, we're going to push them to like get public, at some point. And like, they never have that conversation like with the founder, and like, Once Upon a Farm filed for an IPO. But like, I haven't seen a whole lot of IPOs, recently out of our category. So, um, what's your approach in terms of like getting that alignment with the founder and how should a founder on the other side of the coin, how should they think about like having that conversation or like surfacing that agreement, so to say?
I think it's as simple as having the conversation, Drew, around like a simple but yet complex question of what do you what are you building towards? Like, what do you want to like what time horizon and what do you want it to be? And it goes from everything to what do you want the brand to stand for? What do you want the products or services to end up doing? Where do you what is your vision on how on their own role and team evolve over time? Do they want it to be a family business? Do they want to pass it
Mhm.
down to their kids someday? Do they want to sell it to a strategic? Do they want to go IPO? So almost like an M&A slash capital markets question of what their goal,
Yeah.
and having an open dialogue around what those goals are and their time horizon to do so and how they want to work together, and having open dialogue around what is their work style versus what is their investor or board or other management team members, what is their work style, and seeing how that all fits together. And then, like I said earlier, doing their due diligence on their potential investment partner on how they can be helpful towards those goals versus what that person only purports to be able to do.
Yeah, I think that's a good point. The diligence side, especially, like I used to not really think about it that much, and I was like, when because we raised money for my last company, and then like now that I'm like a little bit older and I've done it a little bit more, I kind of like think about like this is like you're not my boss, I'm not your boss, like we are like business partners,
Yeah.
and like I have to like you first of all, like I have to like want to go like get a drink with you at some point, because like we're gonna be doing this for like a really long time, so I think like not only can you, to your point about like sort of diligencing the investor, like not only can you get a sense for like how they operate, but you can also get a sense for like, is this the kind of person that like I'm going to be spending more time with them than almost anybody else. So that's another thing that I think people probably look past a little bit too much.
And sometimes there's trade-offs, Drew, and they should also just go into it knowing there's trade-offs because there could be scenarios where they go, hey, would I love to have best terms, most helpful partner, someone who I align with from a chemistry and fit standpoint, um, and an alignment on vision, and have all of that lined up. But sometimes that's just not the option sets. But if
Yeah.
anything, that diligence, they still get a feel for what they're getting and what they're not. So they're making a very eyes wide open decision on what it is because there could be a scenario where that's just maybe they don't have the right resources, but they're a great fit and their terms are good. Hey, that could be pretty
Yeah.
good,
Yeah. It'd be like one of those like triangles, like cheap, fast, or cheap, fast, and I don't know what's like there's like the triangle of trade-offs. Yeah. I mean, yeah, there very well may be somebody who says, hey, look, I don't care if this guy is the worst person or girl is the worst person to work with ever. If they're going to pay me this price, then I'm happy to do it. So yeah, as long as they're making like that informed decision.
It's an informed decision, to your point on that, on what they're choosing to do. And just again, knowing kind of making their decision eyes wide open. I think the challenge is when someone believes that what they're getting is something different, and then that creates, it's already hard enough to build a great business and brand. That becomes
Yeah.
a mental distraction for the company. It's because they thought they were getting something and they got something very different. They didn't make an eyes wide open decision. And so that time investment in the diligence of a potential investor is worth its weight in gold.
And by the way, if you end up if as a founder, if you end up getting something that you didn't expect, I would say probably 9.5 times out of 10, it is going to end up working out in the investor's favor, because they understand that fine print quite a bit more intimately than the founders do. Um,
But I think it's a
so
lot
wait,
more than technical and legal terms, though, Drew. I think my point is it's this holistic diligence on fit, value add, and walking through different scenarios of what it's like to work when it's good and when things are not as good. Because inevitably there's ups and downs to everything, and is there good alignment and chemistry between these potential partners.
yeah, 100%, yeah. Wayne, I have maliciously stolen 10 extra minutes of your time. So I want to be mindful of your calendar. I know you're a busy guy. I have one last question before we go here, and that is, and this is something that I think I'll ask every single person because I think there's an interesting answer usually, hopefully. Why did you get into consumer? Like what drew you to the consumer products industry?
So I joined this space. I was actually in the automotive industry.
Okay.
So I started my career at Deloitte. Then I did a quick investment banking tour at RBC Capital Markets, and then I had this unique opportunity to become CFO of a car dealership platform.
Oh, cool.
25 years old, and I saw the power of brands. You know, Even at that time in the mid 2000s, basically the technology and quality of each brand of automobile pretty much the same. You know, it was
Yeah.
really the power of brands and the trophy that a car represents about a person, of like what they want to portray about themselves and the emotional connection they have between themselves and whatever car brand that is. And I really wanted, just to be frank with you, a chance to be in the lower middle market private equity space where it's a combination of financial and operational experience.
Mhm.
And I feel so thankful that I had the opportunity to meet the founders of VMG in 2007, and they took a chance on me. And
Yeah.
I've had the pleasure and benefit of growing up essentially for most of my career in this industry, supporting entrepreneurs and brands and learning on the job. And now I'm 18 years in, and my mission is to support a broader industry in order to be able to be helpful to it. It's my passion and mission. And to be able to help spread 18 years of experience with as many folks as I can to hopefully positively impact their entrepreneurial experience in the space.
That, my friend, is a mic drop. So we will cut it there. That's amazing. Wayne Wu, everybody. Thank you so much for joining us.